Today on the final bar, the short-term recovery appears to continue with the S&P closing just around that 4,300 level yet again. Bitcoin bouncing off of key support. Is this yet another sign of back to a risk-on scenario for assets? Finally, Samantha LaDuc of LaDuc Capital will be joining us from the Boston area. Semiconductors, what can they tell us about current market conditions? Ladies and gentlemen, this is the final bar. Hey there, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market activity using the best practices of technical analysis. The StockCharts platform was created about 25 years ago to empower online investors to use technical analysis to make better decisions. We've evolved stock charts over time. We have a lot of users doing a lot of different things with technical analysis, but in the end of the day, it's all about focusing on the evidence the markets provide back to us in the form of price, breadth, sentiment, measures of trend and momentum, all those things we can do to quantify and qualify market movements. Now today, we sort of have a bit of a continuation to yesterday. Yesterday going into the close, a bit of a bounce higher. Question was, is that a reversal day? Today, sort of following through to the upside a little bit. Charts like Alphabet back above their 50-day moving average. Do we have an all clear sign yet for this little corrective phase, or are we still just getting started? Let's get to our market recap. Look at what happened today and how that fits into the big picture. Before we go there, I do want to start with a quick poll question. We asked you recently on our social media accounts and on our YouTube channel, does the S&P 500 make a new all-time high before year-end 2023? Two answers, absolutely or no way. 2 out of 3 of you said no way, there's no chance the S&P gets to a new all-time high before year-end, which means about a third of us say, yeah, it could happen. Let's look at a chart of the S&P 500. Again, none of us know for sure, and with these sort of questions, I don't want to imply that you can have a crystal ball using technical analysis. Carl Swenlin, one of our longtime stock charts contributors, says technical analysis is a windsock, not a crystal ball. It tells you the conditions and the overall trends, the waves, but it doesn't necessarily predict, right? Nothing can predict exactly, but we can pay attention to probabilities as implied by price patterns and trend analysis. So here's the problem, right? As we get lower and lower, the rally, the percentage gain we need from the current day to get to that new all-time high is getting bigger and bigger. And the chance of that happening by the end of the year probably gets smaller and smaller. Now, here's the thing. I would argue, and I think this is probably going to segue into my conversation with today's guest, Samantha LaDuc. I think the challenge for our benchmarks is they are very growth-oriented benchmarks. So when I think about the likelihood of the S&P making a new all-time high, I guess the question I really am thinking in the back of my mind is, what are the chances that interest rates stop going up to the degree that they have, or at least stop being high, stop being elevated, and start coming down? Because that's what I think it would take for our growth-oriented benchmarks to have material gains much, much further to the upside. High rates are not good for growth. Our benchmarks are super growthy here in 2023. That's been the case for a while, but it's become exaggerated here recently. There's such a weight on those mega cap names in the growth sectors like technology and communication services. I'd probably say no. The chance of the S&P making new all-time high, I don't see it in 2023. I'm concerned about when it will occur. One thing I have zero doubt on is that at some point the S&P will make another new all-time high, and that's what I try to remind people when they talk about going short. Going short stocks is a good short-term strategy when the stars aligned and it's an appropriate time to do so. But over the long term, shorting the market has been a losing proposition from the basically the beginning of equities. Let's keep going and look at the market through the lens of the market dashboard here. Starting with the major equity averages, the S&P finishing up 0.6%. Really close to 4,300. I'll call it around 4,300, but sort of chopped around there in the last hour or so. So nice bounce house higher, about 25 points above yesterday's close. Again, 0.6%. The Nasdaq Composite up 0.8%. Small caps actually led the way higher, 1.1%. Had a number of conversations about small caps over the last, over the 2023, because that's one of those areas of the market that's just not participated in the upside. The breadth conditions looking at the small cap space, not particularly strong right now, to be sure, and it generally have been weaker than the large cap breadth indicators. We're seeing a bit of a bounce here this week with small caps yet again today pushing higher. The VIX coming off a bit. The VIX yesterday was just above 18. Now we're getting down to around 17.4. So one of those warning signs, one of those red flags when conditions are bullish, when the markets are trending higher, things that I look for as an indication that that uptrend might be in a big question mark. Number one would be price going down. That's the most obvious one, right? We make a lower high, we make a lower low, those sorts of, basic Charles Dow style reversal signals. Another one would be an elevated VIX, right? And the VIX being very, very low and then rotating quickly to go high. Now, we've seen a spike in the VIX off of the July market peak into the August low. You saw a spike of the VIX up to around 17, 18. Then again here recently over the last week, from last Wednesday when we dropped after the Powell press conference, continued lower into last weekend. You once again saw the VIX spike higher. Coming off a bit, still pretty high relative to where we've been over the last couple months. Still, though, in a low volatility environment, the VIX over 20, that's sort of that general alert that I look for. And the moment I see the VIX over 20, I immediately start thinking about a high volatility environment, previous high volatility, which tend to be bearish market scenarios, and just making sure that I'm prepared for more volatility and potential for more downside. Now, interest rates actually moved lower today, and it's not been often that I've said that on the show as I think about my market recap. This is the first day, and I don't know how many that I have read on the page of interest rates, because in general, we've seen rates going higher and higher here, over the last 6 to 12 months, but particularly in the last couple weeks, you've seen this spike higher in rates. 10-year yield came off a bit today, but not by much. Still around 4.6% for the 10-year. Long bond yields around 4.73, and the 5-year point around 4.64%. The dollar came off a bit, about 0.5% lower for the UUP. That's one of the worst days for the dollar we've seen in a little while as well. Looking at some other asset classes here, gold down about 0.5% using the GLD. Silver prices slightly higher. Precious metals have not been particularly strong recently. While crude oil prices have gone up, precious metals have been coming off. A bit of a mixed bag today with copper prices moving higher as well. Crude oil actually came off today, and so as a result, energy, not one of the strongest sectors, which again is a bit of a different read than we've had on the markets here recently. Finally, with cryptocurrencies, a lot of green today. And if you look at the 2-day little preview chart of Bitcoin, you can see this big spike higher. Currently, Bitcoin finishing around 27,140, we'll call it. Of course, these trade 24 hours, so we're just taking the most recent data. It's up 3% from yesterday. Ether price is up about 4%. So you are starting to see a nice rally in Bitcoin and Ethereum coming off of pretty well-established support levels. Bitcoin was retesting the low, I forget what month that is. We'll look at the chart here in a few moments. But a low around 25,000. We bounced off of that a couple times so far this year. Recently, here in the last couple weeks, we found support at 25K and again rotating back. Potentially, we see Bitcoin trending back up towards previous highs, maybe looking at a new high for the year. I would say that is much more likely than the S&P making a new high for the year, but that's just my gut looking at the charts and the trends. Finishing, looking at the sector returns, so communication services and consumer discretionary actually finished at the top of the list, just edging out materials. Materials were at the top of the list for much of the day today. Real estate as well, all four of those sectors up about 1 to 1.1%, so a nice follow-through move to the upside. On the downside, utilities really getting crushed recently, down 2.1%, 2.2% again today. The relative strength on utilities has really rotated lower. Energy up slightly today. Consumer staples up 0.3%, rounding off the bottom three for the day. Let's go to the daily chart of the S&P, and again, we're sort of in that weird limbo where we've now engaged a particular support level, and now we're sort of chopping around there. So while I can't tell you we've had a big follow-through move to the downside, because I don't think we have, right? We closed below this trend line using the October 22 and March 23 lows. If you line those up using the intraday lows, that lines up pretty much to where we're at today, right about at today's close, because it's right around 4,300 at this point. Now, we closed below there. This was on Tuesday's session. Wednesday, yesterday, we kind of had this choppy, volatile session. Ended up looking kind of like a hammer candle for the SPY. Today, pushing higher into the close, and we're sort of right at that trend line. So not enough for me to say the trend line is clearly broken. Not enough of a bounce for me to say this is now obvious support and we're just retesting it again. It's still an open question. And I've mentioned this, I feel like, many times recently. Jesse Livermore famously said There's a time to go long, time to go short, time to go fishing. Dave Landry on the show last week mentioned an interesting time to sit on your hands and just be patient. I feel like that's sort of the time, right? I don't know if you can declare this a huge sell signal. I don't think you could declare this a huge buy signal that we're finding support. It's still an open question. I think the move out of this little consolidation that we formed over the last couple sessions could be pretty instructive. That's what I will certainly be looking for. And in general, right, big round numbers. We remain below 4,300. This is just not that strong of a tape because that would get us back above those levels and pushing higher. Overall, I'm inclined to think we are still in a distribution phase until proven otherwise. And I will tell you that because we're making lower lows and lower highs. So what would change this? We need to start making a higher low, right? And that's what would tell me, or a higher high, right? We start making, instead of making a lower high, we make a higher high, which means we have a lot to prove before I think the S&P chart looks more bullish. At this point, it seems in the short term, certainly, to be in a bit of a downtrend. One of the charts that I like to throw around is called the new Dow theory. This just simply looks at the closing basis S&P 500 and NASDAQ composite. There's a book, forget the author, and I should look that up because I mention this book often, talking about what's called the new Dow theory, adapting Charles Dow's original work to more of the modern age and using the S&P representing the old economy, the NASDAQ composite representing the new economy. I like to look at equal weighted versions of that, which I've talked about on the show as well. But the reason why I wanted to show this, just the S&P on the closing basis, while on an intraday basis, we've kind of gone below. On a closing basis, for now, we're just testing this support level almost perfectly using the log scale chart. So it's lining up just really well. Now, the NASDAQ composite bounced off of the same trend line in August and now has clearly broken down. So if you look at most indexes, they've already broken down through this trend line. The only one that hasn't is the S&P. So when breadth indicators have already broken down, when the NASDAQ and small caps have already broken down, and the only thing that hasn't is the S&P, I feel very skeptical that the S&P will magically hold and everything else gets better. It feels like the S&P is sort of the last thing to wake up and recognize the conditions and starts to break down a little further. That's what I would expect here, but let's look at the evidence. For now, that trend line appears to be holding. Now, different measures of breadth can help you characterize the market in different ways. One of the ones that I like to look at is the percent of stocks above key moving averages. As the S&P is sort of threatening this 4,300 level, trading just below it, worth noting that the percent of stocks in the S&P above their 200-day moving average has gotten right down to 40% this week. You know, the last two times we got down to 40% was in May and in March. In March, a very similar kind of pullback to what we've seen. To this most recent pullback has taken a little more time than we saw in February through March. That was about a 6-week pullback. We're kind of pushing almost 7-8 weeks at this point. But overall, the trend, from the percent of stocks above their 200-day up around 75, 80%, down to 40%, very similar to what we saw from the end of July to now late September. In May, we got down to the same level. This is more of a time correction, right? We didn't pull back as much in terms of price terms, but we definitely spent some time. So I would think of it as more of a time correction. So what's interesting here is this indicator has gotten down to similar levels that we've seen on some of the more recent drawdowns, right? And these previous ones have rotated higher. One of the great all clear signals we saw in these previous observations was this indicator getting back above 50%. That's something I might want to look at here. This is why this might be an important chart to pay attention to. Also note, less than 1 in 5 S&P names above their 50-day moving average. So that would certainly have to improve as well to tell you that there's more buying or better buying coming in. Finally, just to finish off our market recap, we have a couple more minutes. I wanted to show the chart of Bitcoin. And the reason was because I've been chatting with some of my peers in the industry about Bitcoin. One of the things that we've talked about is just this bounce off of clear support. When you look at the chart of Bitcoin, just to orient you here, we've got about a 1-year chart looking at daily closes, maybe a little more than a year. What I'm looking at here is the November low from last year, connecting that to the April high from earlier this year. We drew down to about the 38.2% level. So that's a 38.2% way back to the November low. And then we bounced back higher and retested the high. Here we had that clear bearish divergence in June and July. We're rotated back lower. Now look at where we spent almost 3-4 weeks testing that same level, 25,000. We never really broke below it, found that same support, and now we're rotating back to the upside, making a bit of a higher low around 26K over the last week or so. So starting to appear to be more constructive. The RSI is pushing 60. And in general, if you look at these green shaded areas, this is when Bitcoin has been more of in a bullish phase. The RSI has rarely gotten below 40 on pullbacks, and it's often gotten above 70 on upswings. We've been in more of the bearish phase here recently in July, August, September, where the RSI has become oversold on drops, and it's rarely gotten back above 60. We're kind of right at that key point where all of a sudden this could start to look like a much more constructive chart. I'm also looking at the 200-day moving average, currently around 28,000. So for now, it appears to be finding support, making a higher low. I like the upside potential here. I would say, obvious resistance would be here in the 30 to 31K range. That's where we found resistance in April. Also in June and July. I think there's a lot to prove for Bitcoin to get above there, but certainly as a short-term move back to those levels makes sense based on the technical configuration that I'm seeing so far. Just to finish off here, when we talk about sector rotation, have to note things that are working on the upside and things that are not working or things that are rotating to the downside. Utilities falling off a cliff in a pretty big way here. The last couple sessions have been really negative. Now, the price movement is one thing, and utilities in general, not a super exciting chart price-wise because these are pretty low volatility, pretty stable names, and the value proposition for utilities is usually more of the dividend component, the income implication of some of these higher yielding, lower beta names. The problem is with rates so high, the utility stock doesn't pay as good as a savings account in some cases. So, it's tougher to justify those as a good income opportunity. However, the most concerning part I would see here is the relative strength, right? So utilities had just started to turn higher on a relative basis. The last week, you're seeing that relative turn lower. Other sectors have done much better. Energy is the one that always comes to mind when I'm thinking about areas of the market starting to improve or continuing to improve during a period of market dislocation. Just to finish off with a couple individual names, big names you probably know. We'll start with the semiconductor stock. I'm going to talk to my guest today, Samantha LaDuc, about semiconductors, but just wanted to point out AMD, one of the key names I know a lot of us follow in that space, bouncing off its 200-day moving average. And again, I was taught by one of my early mentors, nothing good happens below the 200-day. So I'm always looking for stocks that are able to hold a 200-day moving average because I'm not the only one that looks at that level. And I've worked with a lot of institutional investors, not big chart people, but they always seem to know where the 200-day is, and their trading desk definitely seem to know that. So finding support there tells me some investors are getting in on that weakness, and potentially there's enough upside momentum to push higher. Volume might be important to look there as well to see if there's enough volume on this up day, almost 5% higher for AMD. Just to finish off, Alphabet, right? Most bullish thing a chart can do is go up, and that is the reality. So as much as we can debate what should happen, given the trends and given the overall environment, price is what's most important to follow. So as long as a chart keeps making higher highs and higher lows, I don't think there's a lot to worry about until that changes. So Alphabet coming off of a new high in late August, a higher high in September, pulling back to a 50-day moving average. Now, it went below the 50-day. We pointed it out last week, but now today getting back above there. What's interesting is it also held the low from August. So on pullbacks, do we make higher lows? For now, the chart of Alphabet is saying yes. And it's a good reminder that regardless of what you think about the broader market conditions, I'm concerned about further downside for the S&P, but I'm not concerned about a chart like Alphabet that keeps making higher highs and higher lows. We're going to bring on today's guest, Samantha LaDuc, here in a moment. Before we do so, a couple quick announcements. First off, we're going to do an all mailbag episode tomorrow, and we'd love to answer one of your questions from our Final Bar mailbag. Send us any questions about technical analysis, about market history, investor psychology, whatever it is that you want to talk about. We'd love to hear your questions as you attempt to use this Stock Charts platform to make sense of these markets in uncertain times. Our email is thefinalbar@stockcharts.com. On X, just tag us in a comment at FinalBarSCTV. And on YouTube, just drop a comment below the video you're watching on our Stock Charts TV channel. We would love to hear from you. Hope to answer your question in our next mailbag episode tomorrow on Friday. Also, as a reminder, we do a live Q&A every Wednesday, 1 p.m. Eastern, 10 a.m. Pacific. We had a great one this last Wednesday. A couple of the questions for tomorrow, as I was getting things ready earlier, are coming from that Q&A that we did. So make sure you tune into the next one. Go to our YouTube channel. Under the live tab, you can get a reminder, a notification, so you don't miss our next live Q&A. That'll be next Wednesday, 1 p.m. Eastern, here on our YouTube channel. I want to bring on today's guest, Samantha LaDuc. Samantha is the founder of LaDuc Capital, coming to us from the Boston area. Samantha, a pleasure to see you. How are you?
I'm doing well. Thank you so much, David.
No, I appreciate it. And I feel like I always wish we have more time because there's so much to think about in these current market conditions. I mentioned in the market recap AMD, potentially bouncing off support. The last time you were on our show, we talked about semiconductors. Can you give us an update on what you're seeing in that key sort of bellwether space?
Well, first, I got to go backwards before we can go forwards. We obviously have kind of rolled over in August and September. That lovely seasonality always helps. But so does internal breadth breaking down, perfectly timed with a very large treasury issuance on July 31st. So we have definitely, I think it's what, 7% basically in SPY since that peak. But what's interesting is under the surface, as you just mentioned, breadth. And what I follow, which is net buying selling indicators, part of the breadth analysis, they're still very, very weak sauce. So I kind of go back and take a look at that expansion of small caps. They're still in trouble. They're really flat on the year if it wasn't for the Magnificent Seven, of which NVIDIA is a large player, not only in market cap, but also sentiment with the AI boom. It's also up 1,000% in the past 10 years. I mean, even Apple's not even, up 400%. So I mean, there's definitely this incredible excitement over semiconductors, and in particular AI since May, that very much in large part kind of drove this euphoric bullish move. But since that treasury issuance, which is very, very, very much a supply issue, Treasury dumped a whole bunch of bonds onto the market. And interest rates and dollar have been rising since then. And dollar and yields will trump any kind of sentiment. Really, the narrative will start to turn, and then selling will start to pick up. So that's really what happened. And semis are just part and parcel of one very, very large sector that bears watching because it has been so strong. So as dollar has moved up 5% off the lows, again, in the last 2 months, and yields, the velocity and also the volatility that has come into the market because we've had such a strong steepening in the 2 and 10 yield curve, but across the curve, that's actually now a headwind for equities. So semis are no different. They're not immune. We might be having a very strong technical bounce. We stabilized yesterday into today at a very key level. I had actually 42.40 and it did tag. But we have a reason for why we kind of stabilized. One, market makers and optionality. There's some very large gamma and hedging, put hedging, that basically is monetized. But we also had GDP revision this morning and jobless claims. Jobless claims continue to fall, which is just, case of strong employment backdrop. That is actually helping in wage inflation stay very firm and delay recession. But consumption actually fell and GDP actually was revised lower. So we bounced, or I should say, dollar and yields softened on the prospect of slowing economic growth. So the question really is that really a bullish backdrop for equities, or are equities potentially pricing in maybe more of this potential Fed kind of walking back some of its cuts that it pulled out of the market last week? So I very much look at the macro, the micro, the intermarket breadth, and in particular, this strength of the semi-rotation has been unparalleled, right? And case in point, NVIDIA. But as you can see from that chart, there is a formation I've been tracking. And last time I was on this show with you, I said, I'm going to just take a big look at this in a few months and see if we've actually softened. And we have started to soften and roll over in this intermarket towel.
It's interesting when we were talking about it, you covered so many things there, Samantha. It was really, really well done. When you look at the 10-year yield, right, we've spiked, and you pointed out the steepening of the yield curve, which is sort of a different look now in the last month or two. We've seen the 2 to 10-year spread starting to narrow a little bit, starting to come up here. When you see 10-year yields getting up to 4.6, 4.7%, do you have a terminal rate in mind that you think the 10-year could get to this point and then something important happens? Or how do you think about how far we've come, how far rates have come out, and how that impacts sort of leadership trends that we've been observing?
This is the point, right? So we get to a point where they kind of start to cry uncle. So back in October, we had a lot of central bank intervention that came in October of 2022, and that actually helped bonds from falling further and obviously helped equities get bid. But fast forward, right? We're kind of really working on that same level of yield that we had in the 10-year at 4.33. We're actually above it. And I had written last year that this particular 2023 wouldn't surprise me because, you know, I've been a big bond bear on your show every single time I talk about this. But this has been one of those deals where we are still at risk of moving higher. And I had said last year that if we hit 4.7%, in the 10-year, it'd be about 85 in TLT. So we're closely approaching that. And that is where I think we get a really strong impulse in volatility. So we've come so close yesterday and today, backed off a little bit on, again, slowing economic data prints. But I think once we hit that 4.7, it's not only a kind of an emerging market panic trigger, but it really does upset the apple cart for bonds and bond proxies, and specifically FX. So currency will start to become more fragile. And this inflation that we have, which is very sticky, is very much weakening to most local currencies, which is giving the strength, the seeming strength in the dollar. I actually think we have some more to go in the dollar, and that yield price target of 4.7 will start to help semis and mega cap tech in general roll over. So that's actually why I wanted to bring up that second chart, which is it hasn't broken yet, but that growth to value rotation trigger, which, as you can kind of see, has been sideways since June. So we really had this bottom in this ratio, which is literally growth to value, in January. We had the nice January effect. We got supported extremely well in the March 12th, Fed, Treasury, White House, bank backstop or bailout. Then we had the AI extravaganza. And then June 1st is actually when breadth started to expand again. We had a beautiful value rotation. And I deemed that stalking value rotation. And we had a beautiful advance in a lot of value plays relative to growth. And they started to basically kind of compete, which one's going to outperform. So now we're on a critical level. I mean, so the monthly of that SMH to SPY ratio is forming a head and shoulders, which is a reversal pattern. This growth to value rotation is on a daily time frame, and that very much is on support until it isn't. And I think this is where we'll have more selling of the, the New York FANG, the Magnificent Seven, whatever you want to call them, the mega cap tech plays that have been in distribution, like you said, but they haven't really fallen like, for example, bonds. So I think there's a lot of safety still in that concentration risk of mega cap tech. And I think we're going to see some volatility come into that space for the rest of the year.
It's some really good points in there, Samantha, particularly with growth versus value. It's so interesting. I think it's surprising in some ways that they're so evenly matched here in the last couple months, but I guess it makes sense. If we do get that breakdown in growth and value starts to outperform, there's sort of a couple different buckets of value, right? We have sort of the cyclical energy, industrial type of value. Then we've got the really defensive kind of utilities, REITs kind of value. Where do you see opportunities if the growth stocks start to come down? What rotates into a position of leadership?
So this is tough because we've had energy outperform now for 3 years. So since it came up off the bottom, and oil as an inflation hedge, right? And inflation has absolutely stayed sticky. We really have had outperformance in energy, which has been a baseline bet, but it's been 3 years. Now, energy outperforming is actually a bit of a headwind, not only because of the underlying, strength in crude and other oil complex is just a headwind for margin compression and cost of living and everything that's related to, consumers and corporations. So that's one thing. It has definitely been a place where a lot of folks have hung out and been really well rewarded by not having to worry because it has been so strong as a sector. So I don't think it's going to go away, but it does worry me that there has been so much concentration in that space. And of course, at a point, it becomes a bigger headwind as a sector rotation leader. So then you go to kind of, okay, what about anything tied to China? Not so much. So there are industrials and others that, as long as they're tied to commodities, because I'm a commodity bull, in general, not just uranium, which has had a phenomenal, ascent. Also part of that things over paper mantra since summer of 2020. But I'm talking wider, not copper, because that's actually an economic slowdown tell, and China's buying less, and they're the largest marginal buyer. So there are, in general, things that are inflationary that are better bets, that are obviously core to some companies' assets. I'm interested in that, and their ability with earning interest on their cash or cash equivalents, like Exxon's doing extremely well, for example, right? And then there are a lot of zombies that are going to go bye-bye. So the zombies in that small cap space. So if you look at the market to date, here we are approaching October, we might have the S&P now pushing very, firmly higher, but the stuff underneath the surface is a mess. So we're actually down on the year for the Russell 1000. We're down 7%. We're flat as it relates to the Russell 2000. So mega cap tech or the Magnificent Seven have definitely been carrying the mantle, and that's a big burden. That's what I'm worried about, is actually that other ratio chart that we talked about, which is Russell IWM to SPY on a monthly basis, has broken down to 2008 lows. That's not actually bullish either. It shows that there's a lot of risk actually in these smaller cap plays as they have to refinance their debt next year, as they are dealing with a slowing economy. So I think actually we have very few pockets that are safe as it relates to value. So yeah, energy is going to be fine. It's going to go down less, but ultimately there are going to be material stocks and some that are tied to real estate, just because it's holding its value, it's not falling. But as we start to get through the year in 2024, even those will be challenged as we pull forward a recession. But right now, I still think we're still paid to wait, and then very selective value plays that are not going anywhere, that have very strong balance sheets, not the zombies, not the mid cap tech. And I think mega cap is going to be pressured.
Rocks over paper. I love that comment. I love that thing to keep in mind for sure. And you've certainly seen some of those movements that you referred to. Samantha, thanks so much for putting that all into context, hitting on a number of different key themes here. I think we have a lot to digest and certainly a lot to prepare for here going into the fourth quarter. Be well, stay safe there in Boston. We'll talk to you again soon, Samantha.
Thank you so much.
That's Samantha LaDuc. Samantha's the founder of LaDuc Capital, coming to us from the greater Boston area. And I love the comments about, interest rates. When you think about how much the rates have gone up, to summarize one of the comments that I think Samantha made very well is, don't confuse the top of the page with resistance. When I look at a 1-year chart of the 10-year, it's gone up a ton. Now, at some point, that starts to revert, and you get a bit of a mean reversion. I think that could be something that she was talking about around the 4.7 level for the 10-year. A number of key levels to pay attention to. Can't disagree with the importance of semiconductors and a rotation away from growth. I think we're still beginning that trend as well. Great take there by Samantha LaDuc at LaDuc Capital. Folks, we've got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. When I'm looking at this market, Samantha LaDuc, I thought, mentioned breadth a number of times and just the weakening breadth conditions. And I would 100% agree. We've been sort of tracking those declining breadth readings, things like the bullish percent index, things like the percent of stocks above moving averages, just the advanced decline lines of the McClellan oscillator, all have been reflecting this negative, more bearish rotation, more bearish feel to the tape. This is a chart that I love because it's colorful, and the green bars basically say more new highs than new lows. The red bars tell me more new lows than new highs. And what I mean is this is basically just showing you for the New York Stock Exchange and for the S&P 500 at the very bottom, how many companies are making a new 52-week high and a new 52-week low on any given day. If you look at what's happened in the last week and a half, really since last Wednesday, I see a lot of red bars and I see very few green bars, or very small green bars. That shows you how many stocks are making new 52-week lows. Not new 1-month lows, not new 1-quarter lows, but a yearly low, which means they've gone down quite a bit or have been going down for quite some time. Very few stocks making a new 52-week high, and that just shows you, even though the S&P really not that far below its previous high around 4,600, you're just not seeing a lot of individual names that are in the driver's seat. An uptrend for the benchmarks is driven by an uptrend in individual stocks. So you need to see less red and more green on this chart, I would argue, to be more bullishly minded in terms of market trends. Now, one of the interesting conditions that we've been observing on top of weakening breadth and on top of prices coming down in general, the fact that offense versus defense has remained pretty much leaning to offense. If you look at consumer discretionary versus consumer staples, we have the cap-weighted version at the top, the equal-weighted version, which is the one that I prefer because it kind of takes the mega cap impact of Amazon and Tesla and others out of the picture and just focuses on the stocks that make up these indexes. Overall has essentially been flat, but it really hasn't broken down. So you're not really seeing a broad rotation away from growth offense into defense. You're seeing a rotation from growth offense into cyclical sectors like energy. I would agree with the opportunities that we've seen in energy. We've been talking about that for a while. The upside for commodities, for materials, I think is very much there. Really haven't seen that materialize too much, but we've definitely not seen a broad rotation to defensive. I also mentioned in our market recap, utilities breaking down big time. Now, with that in mind, all the charts we talked about, all the negative breadth conditions, some charts still work. And I think that is the beauty of a technical analysis process. Have a regular screening session that you use. In Grayson Rose's last show, Stock Charts in Focus, I think this is from last Friday or maybe the Friday before, he did a session, a show purely on automated scans, scheduled scans as we call them. So every day, every week, you can have chart lists populated by the results of different scans. He runs a series of scans for stocks making new 1-month highs, new 52-week highs, all sorts of other combinations for new lows as well. And I do a very similar process with stock charts at the same time. This is something that came in one of my new swing high screens recently. I just want to highlight a chart like WestRock going up. This is actually looking at an improvement in relative strength. And I was looking for stocks that were actually outperforming the S&P over the last month. WestRock came back. Now, this is a containers and packaging company, which you may or may not be familiar with, but look at the transition from a distribution phase to a consolidation phase the middle of this year to an accumulation phase. This is a stock making higher highs and higher lows with the momentum strong and the relative strength improving. There are charts like this out there. Use our scanning engine to identify those opportunities today. That's a wrap for this show. Thank you so much for joining us every weekday after the close for the Final Bar. Special thank you to Samantha LaDuc joining us from Boston. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a great night.